Now let's discuss formal auditing processes and methods. There are 6 steps to a formal audit process. Step 1 is to determine the goals and objectives of the audit. Step 2 is to define the audit schedule, the resources that will be required, and the time that's required. Step 3 is formally launching the audit. Usually an audit begins with what's called an audit letter and announcements that the audit is about to begin. Step 4 involves defining the steps that are involved in the audit. Step 5 includes determining the sources of evidence, the samples, the surveys, and ultimately drawing conclusions. And step 6 involves documenting the audit findings and those conclusions. So we've spoken generally about the goals and objectives of an audit, but you'll need to define these for the organization that you're auditing, whether it's internal or external audit. Some possible goals that we've already referenced might include things like reducing liabilities resulting from poor management of intellectual capital, improving the organization's intellectual capital reputation, attracting new intellectual capital to the organization, and increasing the simple oversight of the organization's intellectual capital assets. What you may find is that in preparing for an audit, before there's a formal letter of intent to audit, you may find yourself advising and consulting with the organization on why they might want to audit. We're in the very, very early stages of thinking about and accounting for intellectual capital assets. So it is probably a good idea for you to have a good sense of what some of the goals of conducting an audit might be. You're likely to be in a position to help the organization understand why it should do this. Okay. So as with any knowledge management activity, the time to deliver the result must be reasonable. Audits, formal audits, are very rigorous activities. And there is an expectation that the auditors know how to set a schedule and know how to stick to the schedule. So the other thing is that your audit will probably be repeated, if not annually, at least every 2 years. So keep in mind that the time, the schedule that you set for that first audit is likely to be referenced in the future, whether you're doing the audit or there's another company or organization doing the audit for you. So establishing a schedule is important for getting buy-in from the organization as well. If you can tell them essentially how long it's going to take, you'll gain some trust. You'll manage expectations as well. That, I think, is also important for the team that's conducting the audit. Always keep in mind that resources required to complete the audit must be of equal value to the value of the audit. Ideally, the cost of conducting the audit are lower than the value that results. Okay? So schedule is really critical because the resources that the audit uses are people. There are other sources of intellectual capital. And the less stringent a schedule that you can maintain, the more likely you are to vary, the more likely your costs are to vary from your predictions. So launching the audit is an important step. Brinks provides us with examples of the formal audit letter. Whether your audit is being conducted internally by an internal unit or an external unit, an external organization, you should handle it as a formal activity. Okay? Remember that we want our audit statements, our audit reports, to be of equal value to the statements that are generated by the audits of physical and financial resources. So the audit letter is an important organizational record. It should identify which processes are to be audited, which assets are to be audited, the goal of the audit, the members of the audit team, the audit start dates, and the estimated number of hours and the project schedule. Well, who are you going to include in the audit? Well, keep in mind that the intellectual capital audit is a different animal from a knowledge management maturity exercise. It's different in its approach and its inclusiveness. The units and processes for the assets to be audited should have full knowledge of the process, but as the audit will also surface liabilities in addition to assets, there may be some sensitivities in including all people in the unit or in broadcasting the results beyond the unit. So this question should be answered consistent with the organization's culture and ethics. Keep in mind that there are risks associated with conducting an audit. You should not plan to share the results or observations until you have delivered it to the requesting units and fully vetted it. Okay? You are acting as an objective agent when you conduct an audit. However, there are potential implications that result from audits. So it's important that you maintain strict ethical standards and that your communications are clearly professional. So the audit letter, which officially launches your audit activity, must have a high-level description of how you plan to conduct the audit. This means you have to have thought about it ahead of time. You will also need to have a very well-specified project plan. You know, you've got to have the schedule thought out beforehand. So there's quite a bit of prep work to do before you can launch an audit. Your audit needs to be consistent and methodical as well, because it's likely to be repeated in the future. And also, as an early stage auditor in the field of intellectual capital management, you're setting some possible standards for how these audits are conducted. So being consistent, being methodical, documenting what you're doing is really important. Having a detailed plan will also help you to stay focused and on track. So one of the biggest challenges in conducting an audit of intellectual capital assets is sources of evidence. So here you're going to have to go back to your intellectual capital framework, and you're going to want to align this with your audit objectives. This will help you to identify the sources of evidence that you'll need to collect. And you need to also have agreement with the organization or the business unit on what assets you're going to be looking at. So your starting point are the intellectual capital balance sheets. Ideally, if they're there, and ideally you would have them at the organization, the community, business unit, and individual level. Highly unlikely that you will go in and find them today, but you might be able to put together some proximity of what those are. So assuming that the organization has these in place, you should be able to trace the source of assets and liabilities reported in the balance sheet act to verify them in the accounting. One of the challenges that you'll find, though, is, well, two challenges that you'll find is the interpretation of the assets. In other words, from intellectual capital to intangible assets. What was the effect that they produced? What was the value? And my guess is that we're going to have a challenge identifying full records of liability, that this is going to take some interviewing, some conversations, or you may find sources of evidence in communications or project reports of the organization. So if there is not a balance sheet, you'll need to qualify the scope and coverage of your audit. Limit it to what is available to work from. Don't promise what you can't deliver. So the audit should not generally involve constructing the balance sheet. These should be available to work from. And if you are asked to conduct an audit of an organization, what you might want to do is set up a pre-project. or preparatory step, which is to put those balance sheets in place, and then bring in another component of your organization or your team to actually conduct the audit. Audits generally rely on samples and surveys or field observations to verify the entries on the balance sheet. It will not be possible to audit all the transactions or activities that the organization has performed. So you have to decide which kinds of assets are the most important, or which kinds of transactions you're going to audit. And you're going to have to do some samples. You will not likely be able to, you won't have the time to find and account for all of the assets or to surface all of the liabilities. So you want to select the items for your sample based on the goals of your audit. What are you trying to learn? What are you trying to accomplish? What kinds of evidence and how much of it do you need in order to validate your observations and findings? And again, if you're doing the first audit, you're probably going to want to document a lot of these decisions so that you can revisit those decisions the next year, or the next company that comes in to conduct the audit can see how you made those decisions. Okay, so we talked a little bit about the process of conducting an audit. Now, given what you know about the focus of the audit, I'd like you to speculate as to who you would want to have on your audit team. So take the example that you suggested at the end of the last section in this lecture, and just speculate on who you would need to have on your team. Okay? I guess I would also ask you whether you think this is a one-person or a multi-person team effort. Documenting the audit findings and those conclusions. So we've spoken generally about the goals and objectives of an audit, but you'll need to define these for the organization that you're auditing, whether it's internal or external audit. Some possible goals. Step 4 involves defining the steps that are involved in the audit. Step 5 includes determining the sources of evidence, the samples, the surveys, and ultimately drawing conclusions. And step 6 involves Step 2 is to define the audit schedule, the resources that will be required, and the time that's required. Step 3 is formally launching the audit. Usually an audit begins with what's called an audit letter and announcements that the audit is about to begin. Now let's discuss formal auditing processes and methods. There are 6 steps to a formal audit process. Step 1 is to determine the goals and objectives of the audit. Goals that we've already referenced might include things like reducing liabilities resulting from poor management of intellectual capital, improving the organization's intellectual capital reputation, attracting new intellectual capital to the organization, and increasing the simple oversight of the organization.